I bought this block of 6 flats behind me, and in this video I'm going to tell you exactly how much money it makes, what's the pros, what's the cons, what's the things to look out for, and is residential property investment really worth it anymore? Let's find out. So here's an example of one of the flats. Now there's 6 in the block, and I've done a variety of deals here. So I've got some on ASTs, but actually some on long lets to an Airbnb business called Luxury Stays, and they get around £120 a night. It's quite in the middle of central Southend. The train station's there, right near the city, right near the seafront. So quite highly desirable for Airbnbs because it's a tourist town, but also a big town of e-commerce as well, or commerce in general. So this is the basis of what we've got here. 6 in the block. I've given you a little bit about the numbers, but later on in the video, I'm going to get down there with the whiteboard and give you the full profit and loss, the numbers that makes this all work. Why I'm not such a big fan of residential property anymore, and how you can make it work for you if you do have some residential property still. Interesting fact about this place as well. So I only paid £500 worth of stamp duty to acquire this whole block of flats. This building's probably worth 1.2 million now, and I only bought it a few years ago. How did we make that happen? It's coming up later on in the video. Now this street is quite in the middle of the city of Southend-on-Sea, and you'll see that there's lots of commercial offices around us, accountants and solicitors. In fact, this block of flats used to be a solicitor's office. Now, my predecessor that owned the property before me had bought this as a commercial to residential conversion. Quite trendy for lots of property investors to do that right now, because you can buy a commercial property, like say an old shop with some flats above it, and convert it all into residential and then sell it for a much higher multiple. Now, I don't like buying property to flip it. I prefer to hold property and collect the rental, and I much prefer commercial property. But when I came across this deal, I couldn't help myself. Here's why. Now, I actually bought the limited company that owned this property. It was in a SPV, a special purpose vehicle, a limited company that just owned this property, and it was laden with debt. And so I took on the debt, and there was actually only £100,000 worth of value in the company. So when I bought the company, I only had to pay 0.5% stamp duty on £100,000. So it means that I got to buy all of this asset for just £500. Now, my ears always prick up at little deals where you can find companies for sale that own property, because you only pay 0.5% stamp duty, and you only pay on the value of the balance sheet, the excess equity after debt. Because once you've cleared the debt, whatever's left, you pay the stamp duty on. It was a brilliant deal for me, an hallelujah moment, because I would never buy this. Because if I was buying this now for £1,200,000, I'd be paying tens of thousands of pounds worth of stamp duty. In fact, I just bought a £750,000 house and paid £50,000 worth of stamp duty because I had to pay the 3% premium on a second home if you're a property investor. And that's why I've fallen out of love with residential property. To buy residential property, you're putting up so much cash. So that sort of breaks down the deal. I actually paid £650,000 to acquire the company, cleared the debt, which was around £550,000, and so there was about £100,000 balance left. It was just a great deal. Even if I'd have paid the whole £650,000 and it was in a limited company, my stamp duty would have been 0.5% of £650,000. So it's a great deal, really. Really, really good. And it does impressive rents. Let's break the numbers down just a little bit further. What you're looking at now is some drone footage of the back of the property. You can see where it's been extended. Now, my predecessors had quite liked the idea of property development. Now, here's a word of caution for any entrepreneur and business owner. Every time I go into building stuff, whether it's for my main businesses or whether it's property building, it's always a distraction. And I always think if you're an entrepreneur and a business owner, put your time and effort into the trading part of your business. Look, stuff like this is a good place to park wealth and secure it. Should anything happen to you, give security to the bank to borrow money to grow your business, or if something happens to me, my family can use this in my demise. And that's why I do it. But I don't want to be developing and doing property investment and growing properties by building stuff, because I'm not a builder. I'm not an architect. I don't understand the nuance of property development. And just like my predecessor, got a spreadsheet out, thought, oh, I'll put this money in here, I'll bag myself hundreds of thousands of pounds worth of profit. But that wasn't the case. She actually lost money on this because she was turning herself into a property developer without all the years of experience. And that's a big lesson that I've learned from building stuff. If you're not a builder, if you're not an architect, think very carefully about doing it. If you're an entrepreneur, run your bleeding business. You can make a lot more money by sticking to the things you know, or you buy in someone else's hours of 10,000 hours of mastery to do the stuff for you. And that's what I've learned. I just wanted to put that in there because I don't like property development unless you're really good at it and you've got 10,000 hours of practice. Right, now there's some things that I want to talk about while we get into this. Unexpected costs when doing construction, because that's where my predecessor went wrong. If you're not funded and you haven't got the time to do it properly, it can take you out. And that's what happened there. I want to talk about the return on investment calculator and what are the numbers? What does it actually cost to run a business like that? Okay, let's do the unexpected costs first of all. Let's tick that one off the list. Now, you've got these things called seal payments. When you're doing construction, sometimes you have to pay a lump of money to the local government. Now, when I bought this property, she hadn't actually done that. Because I bought the limited company, when you buy the limited company, you take on all the problems, warts and alls. And if you don't pay some of those fees, you can never get a mortgage on the property. So that was an unexpected cost, the seal payment. I had some tarting up and finishing of the property because they'd run out of money, and I had to pay the bridging company as well because she got bridging debt, which is one of the most expensive forms of finance you can get, and usually the only way you can get construction finance going unless you haven't got your own money, because banks don't like doing construction finance unless you're really well established and really know what you're doing. So there were some of the unexpected costs that my predecessors had. Now remember, I bought the limited company. Why is that really advantageous? Because I get lower stamp duty. And let me be clear, that would have been a £40,000 stamp duty day out, and I only paid £500 because I was buying it. The value of the company was only £100,000 because I had to clear the debt. Okay, so there's some of the unexpected costs and a little win there as well. And this all comes into this, the return on investment calculator and the numbers around this sort of a deal. So we was buying a block of flats. What was the purchase price? Well, the purchase price was £650,000, and I had to clear all of the bridging debt and pay off some of the fees. So my total closing costs for buying this property was £170,000. Now, I got a mortgage on the property, so 25% of that price was in there, plus I had some closing costs, solicitors' fees and the seal payment, etc., etc. But the stamp duty was really low, and that was a massive advantage. Okay, so that was the purchase price. That's what we paid for it. Let's work out the return on investment. Now, my positive cash flow on this deal is £29,000, and I've put £170,000 into the deal. So this is my positive cash flow. This is my cash in. And I'm going to put that all in the calculator in a minute. Where have I got those numbers from? So £65,000 worth of rent comes in each and every single year for the block of 6 apartments. Some of them are on ASTs, short hold tenancy agreements that I've got direct with the clients, and we've rented out 2 of the properties on a long lease to an Airbnb company. So £65,000 of rent coming in, and it cost me around £3,000 a month to look after the investment. That includes mortgage interest, that includes some repairs, some maintenance, insurance costs, and all of that good stuff. So that comes to £36,000. Now, I take the £36,000 off the £65,000, which leaves me £29,000 worth of positive cash flow. So now my cash in was my legals, that seal payment, and my deposit, and some fees. Okay, so we've got the 175,000. We divide these two together. So you've got £29,000 divided by £170,000 will give you a number, which you then times by 100, which comes out roughly to 17% return on investment. Now, I'm going to do that now just so you can see me do it here on the camera. Okay, right, let's do it. So £29,000. Remember, that's my positive cash flow. We divide that by £170,000. That's my total cash in to make this deal happen. It equals that. You times it by 100, and that equals 17.5% return on investment. Now, for a residential property investment, that's going like gangbusters. That's a really good deal. Very rarely do you get that in property. Most people are getting 5 to 6%, and they're buying property purely on capital growth. Yes, we want capital growth. Of course we want capital growth. We want the property to go up in value. value. But my view, when you're doing property investment, always buy on cash flow first, and then the winner chicken dinner is when it goes up in value. In roughly 10 years' time, it should be worth double the value that you bought it. And after 10 years' time, obviously your rents are going up with inflation, and rents are going up like gangbusters right now. Why? Because landlords are coming out of the market, because they're so taxed right now, and the government are causing people to sell up all their buy-to-let property investments. And lots of people do still want to rent, thus driving up rents higher and higher. And obviously mortgage rates and interest rates have gone up, causing the costs for landlords to be in business to go up. And so therefore they're passing it on to the tenants. So that breaks it down. Not many people are making positive cash flow out of residential property investment anymore. Very, very few. That's why I'm not buying it much anymore. I saw this one 3 years ago. You can see that this deal really stacked up, and that's why I bought it. One of the quick ways that I think of buying property is this: 10% return on capital deployed. So if you see a property and it's £1 million, commercial, residential, I want to be bringing in £100,000 a year rent. That is my back of fag pack working out. So if I see a property, it's a warehouse, it's £1 million, I think, can I get £100,000 a year rent? That's very hard to do, but if I can get close to it, I'm thinking, I'll go and have a look. I'll work out with the numbers. I'll see if this is the right deal for me. So 10% rent on total capital deployed, whether it's my money, the bank's money, or a mixture of both. If you try and live to that rule, then I think you'll be all right in property investment. If you can't get close to that, very, very difficult. And that's why people are doing serviced accommodation and HMOs. But the problem with those is you are buying yourself a job there. They take a lot of time to manage a serviced accommodation thing or HMO business. That's why I'd just have a hotel and have a team that are brilliant that look after it. And there's much more tax efficiencies of owning things as a trade rather than an investment. I think it's a good point to mention that, right? At the moment, if you're an entrepreneur and a business owner, if you can have property in businesses that look like trades, like a hotel over a block of flats, you'll find that is far more tax advantageous as we're making this video. If you enjoyed this video, why not considering signing up to my newsletter? Every Monday morning at 7 a.m, I produce a newsletter to help entrepreneurs to start their week, based on my thoughts and musings of the previous week, of all the things that I've been up to. And there's some golden nuggets in there that you can use to really grow your business. And it's completely free. Go to my website, jamessinclair.net, and I'll see you in your inbox every Monday morning at 7 a.m. to grow your business. I'm James. Bye-bye.